Okay, so allocating cost to multiple assets. So sometimes you may have a basket purchase. That means you use a single price, but you purchase multiple PPE asset. Okay, so how are you going to allocate that single price to the different assets? So the idea here is the asset is allocated to each, the cost is allocated to each asset in proportion to its relative fair value. Okay. So if parts of an asset have a cost that is significant in relation to the total cost of the asset, then these components are depreciated separately. So this is known as a component depreciation. Okay, so for example, right, when you think about air flight, right, probably the engine has a lot of more value, right, compared to the cabinet, right? Because the cabinet is only the interior seats, right, and the apartment overhead, right? So basically, the value of the engine, right, probably is very significant to the air flight. So in that case, they probably will, take that engine out as a separate asset. Okay. Okay, so now let's work on the first question. Okay, let's work on the first question. So this is the problem 9-1A. So January 12th purchased real estate for a future planned site for 420,000, paying 100,000 cash and signing a note payable for the balance. So you paid $100,000 cash. So you have a balance 320,000 note payable. On the site, there was an old building. Okay, there was old building. The fair values of the land and the building were 410,000 and 50,000 respectively. Okay, that's the fair value. So now if you think about adding them together, so land and the building, right, that's what you purchased. But the fair value for land is 410,000. For the building is 50,000. So together, right, because that's how you pay. You pay for both land and building. So together, 460,000. So when you buy them together, you get a discount of 420,000, right? So you have to allocate the 420,000 cost to the land and to the building based on the proportion to its relative fair values. I think that's the two. And the old building will be demolished and the new one will be built, right? So that's the purpose. So they have to get rid of the old building, okay, and then they build a new one. Okay. So if you do some quick calculation here, okay. So if I consider the one single price for the land and the building is 420. So I need to allocate that cost, right? That's how much you purchased. I want to allocate this cost to land and building. So the question is, how much out of the 420,000 should be allocated to land? How much should be allocated to building? Right? So the allocation is based on certain proportion, percentage, and this percentage is determined by their fair market value, right? So we know that the fair value of the land is 410, and the building is 50,000. So I want to know, based on the fair value, what's the proportion of the two? Okay, so together, for 10,000 plus 50,000. So together, this is 460,000. So the question is, what is the percentage of 410 in 460? Right? So you go 410,000 divided by 460. So that's the proportion for land. Okay. And then 50,000 divided by 460. So that's the proportion for the building, right? And now to allocate 420 to land and building, you just multiply it by 420,000. Okay. So this will be the purchase price, right? For land and the purchase price for building based on this allocation. And that's part of the cost. So you have $9,000 legal fee. So that should be part of the cost. So you pay 70,000 to demolish the old building to make room for the new plant. Remember, we talked about it earlier that the purpose is to remove the old building, build a new building on top of the land. So now you have to demolish the old building, and that cost is also part of the cost for the land, right? For the land. And then you receive the $10,000 residual materials from the demolished building. So you pay the $70,000 to demolish the building. That's your cash outflow. But you also get back 10,000 for that materials, right? So then the net will only the net will count, right? Only the net will count. And then you graded and filled the land in preparation for the construction. Okay, so this is again to get it ready for the building. So and so now you pay the 39,000 architect fees for the building plans. So this would be part of the building, right? The cost of building, that the cost you pay for the design fee, architect's fees. And the building permit, you paid $16,000 for the building permit. So that should be part of the building. And you needed to build a foundation. You first have to extract, right, to lay down your foundation. So that extraction cost for the new building is 18,000. And then the full cost for the construction of building was 740,000. Okay. You have a 1-year insurance policy for the building. Okay. Note, this is only 1 year, right? Insurance policy. So this 5,000 is just the operating expenditure. And now you pave the parking lot, driveway, sidewalks for 55,000. So this will be called land improvement. Land improvement. Okay. Install a fence, 12,000. So that's also a land improvement. Okay. So basically, you record all these transactions. You recorded them. Okay. Using accounting journal entries. So you're likely to have land improvement, and building. That's the 3 long-lived asset account. For each the information, you probably will debit this long-lived asset, credit cash and payables. Okay, credit cash and payables. Okay, so and the solution to this question will be posted to the course website.